Charles, first, what is your outlook for the policy decision? What will Mario Draghi announce tomorrow?
Well, I think he will come through with some kind of further 10 basis point move maybe on the negative rates, in other words from minus 40 to minus 50 basis points, but with an attempted tiering to reduce the impact on the earnings of banks. That's the most important thing. There's also likely to be a revision or revisiting of quantitative easing, for which there's about a year's worth of scope at, let's say, something like 30 billion a month.
Now, we've been hearing from strategists and economists that say there's really not much that kind of easing will do, that kind of stimulus. And even earlier on, our guest took exception to the word stimulus, saying this is not going to stimulate the European economy. Where does it stimulate, if it does, Charles?
I don't think it does. I mean, I think your guests are perfectly correct. The basic point here is that for 10 years now, well, at least since 2011, the Eurozone has run a fiscal tightening and a monetary loosening, and they've reached the end of the road in terms of the impact of that. In particular, the inflation target is a bit of a farce, really, because there's no particular reason for inflation in Europe, and trying to get inflation up seems inherently perverse. If you're running a monetary policy, the normal thing you might expect to affect is nominal GDP, which is a compound of inflation and real growth. And what people are really concerned with is real growth. So focusing purely on inflation is sort of indirect and unnecessary.
But Charles, you're talking about changing the entire mandate of the European Central Bank, and while you might feel that that's the right thing to do, it's not going to happen, right? We had this debate in the United States as well. Targeting something else is just not going to happen in the near term.
No, it isn't going to happen. You're quite right, and that's why what gets announced tomorrow will be thoroughly ineffective. And you've got to realize that there are some respects in which so-called easing actually reduces demand, because German savers, for example, tend to put their money in the bank. Now, if they have if they're saving with a view to retirement, and they have some idea about a standard of living they want to maintain in retirement, then to the extent that negative rates get even more negative in real terms, they have to save more, both because they need a larger lump sum to buy an annuity with, because you know, the annuity has negative rate built into it, but also they have to save more in the interim because the pension fund they're building up has a negative yield in it. So negative rates, to the extent they become more negative, actually encourage Germans to save more. And that in turn means that they reduce demand, which is the opposite of what a stimulus is supposed to do.